Hello, YouTube family. Welcome to the second part of the Trade and Make Money course. I am Divine Akachiko, and in this second part of this course, I'm going to teach you how to analyze your charts, and also we are going to be talking in depth of market structure, right? I'll be introducing to you and teaching you market structure and how to analyze trades on the charts. Without further ado, let's get right into what we have today. Right, so I am in the chart right now and I'm just going to show you something unique today. Now, last class I told you what a buy candle is. And when you see the market going up like this, it means the market is creating series of buy candles. That's why you can see it going up. And when you see a market trending downwards, it means the market is creating series of sell candles. That's why you can see it coming down. And if you remember the last time I told you that regardless of the colors of the candle, that is to say, you can decide to customize your colors based on what you like, but this red and green is the normal default candle color whenever you go to your chart, so you can actually change it to suit what you want. Over here you just select the color. If you want your buy candle to be green, you can select it over here. If you want your sell candle to be red, you can select it over here. If you want to change it or choose any other colors, depending on what you want, you can do that over here. Now, I would suggest that make sure that the buy candle color or the sell candle color that you're choosing, make sure they are contrasting colors so that it's not going to confuse you and you can easily spot which is which. Okay, for those asking how I came to this point, I right clicked on my screen and I went to settings, and that's it, chart settings. Okay, so you can also navigate your way and find, if you're using your phone to do this, your smartphone, if you're using your smartphone and you want to do this, you can just find chart settings. You can easily locate it from there. So today I'm going to be teaching you market structure. This will give you an insight, it will give you a good understanding on what you can see on my screen here, what makes price to be coming down, what makes price to go up. It's going to give you a very good understanding of exactly what you're going to be doing when you want to analyze your charts in the forex market. Now, there's an important thing I forgot to mention. I forgot to tell you about in the previous introductory class. That is to say, this chart right now I'm in, this chart I'm in is called the synthetic market, the forex synthetics market. Okay, why? So this one over here is called the currency market, the forex currency market. And what you are going to be trading in the currency market, just as the name implies, you are trading two currencies against the other. That is to say, you can be trading, this is gold US dollar, you can be trading GBP USD, that is the British pound, against the US dollar, and so on. That is to say, you are trading two currencies, one against the other. So there's Euro USD, euros against the US dollars, right, and so on and so forth. But my favorite pairs that I trade is the GBP USD. That's my favorite currency pairs that I trade. Let me bring perspective to it. My favorite currency pairs that I trade is the GBP USD. I'm going to list them out somewhere here. Let me come here. So my favorite pairs that I trade is the GBP USD, or let me put it GBP/USD, Euro slash USD. USD card. This major trade, these major trade pairs, these are what I trade. Okay, so I also trade gold. So I'll put it XAU slash USD. These are the major currency pairs that I trade. However, gold is not a currency. Okay, so it is classified under indices. But anyways, you can trade. These are the major pairs that I trade in the currency market. These are the major pairs. Let me make this big. Let me make the font black. Right, so these are the major pairs that I trade in the currency markets. However, in the synthetics market, I trade everything. Anywhere I see my setup in, that's where I'm going to trade. Okay, so let's move back to what I want to teach today: market structure. Now, there are three types. When I want to teach market structure, there are three ways I classify it. So market structure can be in three ways. You have the uptrend. Let me write it down. You have the uptrend. You have the downtrend. And you have the ranging markets. Uptrend, downtrend, and ranging markets. And do this. Make it bold. Color black. Alright, so these are the three types of trends that we have: the uptrend, the downtrend, and the ranging market. Let me briefly explain what each of them mean using this tool, the parts tool. So when I say uptrend, the market is creating series of higher high and higher low, higher high, higher low, higher high. This is just what the market will be creating for you. Take note of what I'm saying: higher high, higher low, higher high, higher low. The point where this recent high took out the previous high is called a higher high. All right, it's called a higher high. So as you can see from here, this point here, this recent high took out the previous high, then it sold down a bit. It didn't break this previous low. Okay, so it sold down a bit and went back up and took out the next high. So when market keeps doing something like this, you can say you are in an uptrend. When markets keep taking out the previous high, you can say you are in an uptrend. Okay, so just like this one, market is doing something like this. Going up. All right, so at this point here, you can say market is in an uptrend. You can see how it keeps coming up. It will come down, then it will break the previous zone. You can say you're in an uptrend. Now let me show you how a downtrend looks, just opposite of what I just said. So in a downtrend, market keeps creating lower highs and lower low, lower high and lower low. Alright, this is a lower high. It will create a lower low, a lower high, a lower low. So what can you deduce from here? What can you see from here? you can see that market is taking out the previous low. Market is not breaking the previous high, but it's taking out the previous low. When market keeps doing this, you can say you are in a downtrend. You are in a downtrend. Now, for a ranging market will just be doing something like this. Something like this. Now, if you look at this very well, you see that market actually didn't take out any strong high, as well as market did not take out any strong low. It's just ranging around the inside, right? It's just ranging in the middle. So these are the three scenarios you can encounter whenever you come to your chart to analyze. You can either see an uptrend or a downtrend, or you see a ranging market. So this is what you should identify whenever you come to your chart. This is the first thing when you come to your chart to analyze. Maybe you are analyzing in the synthetics market or you are analyzing in the currency market. They both mean the same thing. It's the same scenario that you can get in these three scenarios. These are what you can you can get both in crypto. Just this is the basics of technical analysis. This can happen in crypto market when you are analyzing some kind of pairs. This is a scenario that you will always see. All right, so let me go to the chart and show you example of how a downtrend will look like, because of course don't expect it to be very sweet like this. Don't expect it to be very sweet. I'm just using this to show you an example of what is happening in the market. It's not going to be very easy for you to identify like this, so you need to spend time in the chart, right? So, but if you zoom in, you can see something. Let me not zoom in too much. If you zoom in, you can see what is actually going on. Can you see? Market is creating lower highs. This is a lower low. It created lower high, created lower low. Can you see this? So at this point, you can say the market is trending downwards. Can you see this? Now, at some point, market started creating higher low and higher high, higher low, higher high, higher low. Market is trying to take out this zone now to form another higher high. If market take out this place, it will become another higher high. All right, so this is just what is going to happen in the market. You don't expect to see it very plain like this. You need to zoom in, so that you see the clearer picture of what the market is actually showing you. Over here, you can see how market is going up. It was trending upwards. Then along the line, market took out. Immediately, market takes out a previous strong higher low. You know that you are expecting a change in trend. The market takes out a strong higher low just like this. This is a higher low, a higher high. Market took it out here. That is, it took out this previous high. Then market took out this low. It started selling downwards. Okay. Now, this is going to lead us to the next thing I want to teach you. How do you know the particular point where market is going to sell to before it reverses? so that you can enter the market. How do you know where market is going to sell to before it reverses and start buying, so that you can enter the market and enter the buy? Or how do you know where market is going to buy to and reverse, so that you can enter the sell? This will lead to the next now to teach you now: supply and demand zones. Supply and demand zone. Write it down: supply and demand zone. Supply and demand zone simply means a demand zone is that zone where market is going to sell to before it continues its buy to the upside. Okay, because before it continues its move to the upside. So what I'm saying is, there's a zone somewhere here that made market, as it broke this previous higher high, it created another higher high. So there's a zone somewhere here where market sold to, then after getting to that point, market reversed and continued its buy trend. So that zone is called a demand zone. That zone is called a demand zone. So that is to say, there's a particular demand zone over here that made this market to reverse and start going up. Likewise here. Why the supply zone? Supply zone is that zone where market is going to buy to. Market is going to buy into the zone before it continue its sell movement. Before it continue its sell movement. So as you can see, market broke structure here. It took out this previous lower low and created a new lower low. So market begin to buy up and tapped into a particular supply zone over here before it reverses and continues its downtrend. Okay, so there's a particular zone where market bought into before it continues the sell movement that it wants to do. Market must always do this. Now, if you look at our charts, you can see markets. Let me take this one for example. Let me use this one for example. There's a break of structure here. Market took out the previous high, and you can see market continued to sell until it gets to a particular zone over here. Until you get a particular zone over here before it reversed and started buying up. Same scenario applies for sales. And see, market took out this previous low, created a lower high, created another lower low. So market took out this previous low. There is a particular supply zone over here. There's a particular supply zone over here that made market, when it began to buy, it came into a particular point here before it continued its sell movement. So supply zone is for selling, while demand zone is area for buy. So when you come to the market and you come to your chart, you want to analyze, the first thing you need to do is to check the trend that is currently happening. If it's a ranging market, or if it's an uptrend, or if it's a downtrend. So after you've identified your trend, depending on what you chose, you will start looking for your supply zones and your demand zones. You start looking for your supply zones and your demand zone. Now, you don't just enter from your supply zone. Even if you are expecting a sell like this, even if you are expecting a sell, you don't just enter from this supply zone because it might be too big for it to enter. So you can refine it. You can refine your zone to a particular place, a particular point where the market is meant to reverse. All right, so the market doesn't just come to the supply zone and begin to sell. No, there's something that happened. There's something that happened when market came into that supply zone. There's something that happened there before it began to sell. Likewise here, there's something that happened before market decides or begins to buy. There's something that happened. So market came down to this demand zone, tapped into something before it starts to buy. Now, what is that something that market tapped into? That is what is called an order block. It is called an order block. So I need you to write this somewhere now. This is very valuable. If you are getting value so far from this video, type it in the comment section. I want to see you in the comment section. Type it in the comment section. Say, I'm getting value. I want to see it there. Okay, so what is an order block? An order block is that point where market needs to come tap into before it either buys or sells. So market needs to tap into that order block before it buys or sells. Now, there are two types of order blocks. You have the bullish order block, and the bearish order block. Bullish order block simply means order blocks that you are looking out for when you want to buy, when you want the market to start going up. In an uptrend, you should be looking for bullish order blocks. That is to say, in an uptrend, when market breaks this previous high and is coming to your demand zone. So when you go to your demand zone, what you are looking for inside your demand zone, once you have identified your demand zone, what you are looking for in your demand zone is called a bullish order block. So you can now enter the market from that bullish order block and enter a buy entry, a buy position. Then the market will tap in and continue to buy. But the bearish order block, you look for the bearish order block in the supply zone. So the market will come into that supply zone, tap your bearish order block, then continue to sell downwards. Write this down somewhere. The bullish order block is the last sell candle before the buy candle that breaks a structure. So when I see this structure break here, I'll just come to this point and look for the bullish order block, the last sell candle before the buy candle that breaks a structure. While the bearish order block is the last buy candle. Buy candle is the one going up, right? So bearish order block is the last buy candle before the sell candle that breaks a structure. That breaks a structure with an impulsive move. This is very important. It needs to break structure with an impulsive move before you know this is actually an order block. So we've spent so much time in this class. I need to round off. I don't want this to be very long, so I'm wrapping up now. I'm rounding off now. Let me just highlight to you, or let me just list to you what validates an order block. What validates an order block? Write this down. What validates an order block? Because you can just see a lot of people keep making this mistake of marking out an order block that they mark out a candle, they mark out candles thinking they are marking out the right order block. Why markets will just come and break that candle and make them to make losses in the market. I suffered this because yes, I learned how to trade Forex, but there's a little information that I've been missing. It made me to encounter losses upon losses until I got the real thing out of pain and tears. So that's why I'm sharing all these things with you, so you don't make mistakes. Okay, so write this down. What validates an order block? What validates an order block? Number one, your order block must sweep liquidity. Number one, it swept liquidity. Number two, it led to a clear break of structure. It led or it leads to a clear break of structure. Number three, it engulfs a candle. It engulfs a candle. These three things are the criteria I need to see in the market before I enter any trade from any other block. Number one, it swept liquidity. Number two, it led to a clear break of structure. Number three, it engulfs a candle. Then I think I need to add this last part. There should be area of inducement. There should be an inducement right above it or below it. Right above or below. So these are the four criteria I need to see before I enter any buy position or any sell position. Number one, my order block I should see a liquidity sweep around that order block. Number two, I should see that this order block that I want to enter from, that it leads to a clear break of structure. Number three, I should see that it engulfs a candle. Number four, there should be an inducement or inducement area resting above it, that is if you are looking for buy, or below it, that is if you are looking for a sell. This thing right here is the holy grail. It's very important. Regrettably, I learned this the hard way. So let me explain what each of these things means. Then we can round off this class for today. Number one, it swept liquidity. Now you ask yourself, what is liquidity? What is liquidity? What do I mean by liquidity? In simple terms, liquidity is what moves the Forex market. The Forex market moved from one area of liquidity to another area of liquidity. Liquidity needs to be taken out before markets will move. Liquidity needs to be taken out before markets will move, and before market will move in the opposite direction. Because markets usually move in the opposite direction after taking liquidity. So let me simply explain. Let me simply just show you everything right here before we call it a day, because I want to round up this class. I don't want this to be very long. So I need you to watch the continuation part of this video, okay? I want you to watch the continuation part. I'm going to go in depth to explaining what all those things mean. All right, so over here we can identify this break of structure. This is the 1 hour time frame. I can see market was creating lower low, lower low, lower high, lower low, lower high, lower low. Can you see this? So this is what we say, we can call this a downtrend, a little downtrend. But what happened next? Market broke structure at this point. Market broke structure at this point. And what do I mean by market breaking structure? You can see the previous lower low we have been taken out, just like this. But after market took out this lower low, instead of it to print a lower high then continue the movement to the downside, market took out the previous lower high. So we call it a break of structure, right? Now, when market takes out the previous lower low, then break structure to the opposite side, we call this particular one a liquidity sweep. I call it a liquidity sweep. Now, this first break of structure that you can see here, some people call it church, that is change of character, but it's not yet identified as a change of character. Yes, it is called a transactional liquidity. It is called a transactional liquidity. Now, market took out this liquidity first, then created a transactional liquidity. That is, it broke structure to the upside. Then there's this overall break of structure over here. In case you are still doubting, is this still a break of structure? Is this a break of structure, or market is trying to deceive me? The market broke structure fully from this point. So you can say, yes, market is trying to buy up. All right, where can I enter this buy position so that I'm not going to miss this market? You can now come to this point. Remember, we have talked about the first one. This is our supply zone, right? This is our demand zone right here. Right? This is where market came into. So this is our demand zone. And we want to look for another block where market is going to enter, market is going to tap into before it continue buying. So we have identified the liquidity sweep. The next rule says it should lead to a clear break of structure. So we can identify that there's a clear break of structure over here. There's another clear break of structure over here. Good. The next rule says it should engulf a candle. So let me explain what engulfing a candle means. Remember when I started this class, I started by teaching you candlestick formation, how sell candle forms and how buy candle form. Many people, as I was teaching it, they think I was just joking, that I was saying something less important. Now this is where it comes to haunt you. This is what you need to know. So look at this. This is the last sell candle before the buy candle, this big buy candle with an impulsive move that led to this break of structure. So this is the last sell candle, right? Now, this buy candle engulfed this sell candle here. What do I mean by engulfed? It overshadowed it. Remember I said sell candle start forming from, let me make this very big, okay? Sell candle, I told you at our first class that sell candle start forming from the top and close at the bottom. They form from the top, just like this one. It started forming from the top here and close at the bottom. And immediately this one close, another sell candle start forming from the top and close at the bottom. Forget about these wicks for now. Forget about the wicks. Just focus on what I'm showing you. But the next candle was a buy candle. and the buy candle started forming from the bottom and closed at the top. So this buy candle completely overshadowed the previous sell candle. So we can say it engulfed this sell candle. We can say this buy candle engulfed the sell candle. That's what it means when I say engulfed. All right, engulfed, the same thing. But look at this one. The sell candle here, there's a sell candle here, there's a buy candle here. The sell candle starts forming here and close here. This buy candle came up and engulfed the previous sell candle. But we are not going to mark here as our entry point. You can mark here as an order block, right? You can actually mark here as an order block. You can actually mark this sell candle here as an order block. And we can actually mark this our main sell candle as our order block. That is from the top of the candle to the bottom of the candle. Top of the candle to the bottom. But then remember our rules. After engulfing a candle, there should be an inducement sitting right above or below it. This we could have called this place the inducement to this zone, but it is very far. It is very far from our zone. But this one, you can see this will be our inducement area. This is a nice inducement area sitting just below, just above our order block, which makes this more valid. Let me add this before I end this class. Let me add this. Anytime markets, any low market creates before breaking structure is a potential area for inducement. And what is inducement? That English looks big, ambiguous. It looks big. Inducement simply means what brings you into the market. Inducement tricks you to enter the market. That's the word. It tricks you to enter the market. So you can be tricked from this point here. You can be tricked to enter a buy entry from here, and you can see what happens. Price can react and break that point. And when market break this point, it means you are losing money. You have hit your stop loss. But then look at how this nice inducement area is just resting above our main order block. Look at how the inducement area is resting just above our main order block. I can see how market took out the inducement, tapped in nicely into our order block right here, and began to buy. So when you want to enter a buy position, you come here, choose this position 2. This is the long position, this is the short position. Long position means you want to enter buy, short position means you want to enter sell. So when you do your analysis finish, you can just come and put your long position 2 like this. Then where do you put your stop loss? This is a low, this is a protected low. So you put your stop loss just a little bit below here, and your target should be at least 1:3. Look at where you can see your risk to reward ratio. That is 1:3, in the sense that, let's say you are entering with $1. If the market goes against you, you are losing $1. If it goes to your direction, if it goes according to your prediction, you are going to make $3 profit. So the risk to reward is called 1:3 risk to reward ratio. In our next class, I'm going to explain more in detail. I'm going to explain more detail about choosing the right order blocks to enter from. I hope so far you've gotten value. If you've gotten value, please subscribe to this my YouTube channel so that you can see more videos like this. Also share it to your friends and your community in case they want to learn how to trade and make money from the forex market. So you can share this video with them so that they can learn as well. I look forward to seeing you in our next class.